Welcome to The Explainer. One of the biggest questions we get from new investors is how to choose that very first mutual fund. And it's a huge deal because that first choice can really set the tone for your entire investment journey.
All right, so let's just jump right in. If you're looking at the world of investing for the first time, it can feel, well, totally overwhelming, right? There are literally thousands of funds out there. So, where on earth do you even begin?
And here's the thing, the big dilemma isn't just about trying to pick a winner right out of the gate. It's about something much, much more important for your long-term success. I mean, think about it like this. Your first fund is all about building a positive habit. If you have a good experience, you're going to feel confident, you're going to stick with it. But a bad one, that can create so much stress and make you want to pull your money out at the first sign of trouble. So yeah, this first choice really does set the foundation for everything.
So what do most beginners do? Well, they tend to go to one of two extremes. It's kind of like Goldilocks. They pick something that's either way too hot or way too cold.
And this really breaks down that problem perfectly. On one side, you've got these super volatile equity funds, the too hot option. Yeah, they can offer big growth, but they can also cause a ton of anxiety and lead to panic selling when the market dips. On the other side, you have the too cold option, super safe liquid funds, but they're really just for parking cash short term, which means you could be missing out on some serious long-term growth. Neither is really a great starting point.
So if you shouldn't chase these extremes, what should you do? Well, the best strategy is to focus on something we call a behavioral advantage. And trust me, this is as much about your psychology as it is about your money. Yeah, this quote absolutely nails it. The whole idea is to create a positive feedback loop for yourself. You want to see those consistent, moderate gains that encourage you to stay disciplined. If your first experience is positive, you're just way less likely to freak out and sell everything when the market gets a little bumpy. That's it. Exactly. The perfect first fund is one that helps you understand risk without totally overwhelming you. It's all about finding that just right middle ground that lets you learn the ropes comfortably. Okay, so what is this just right option? What kind of fund actually hits that perfect balance? Well, let's talk about the specific category that was basically designed for this job: conservative hybrid funds. And you can really picture it just like this. A hybrid fund is, well, it's a mix. It combines two totally different types of assets. You get a piece of equity for that growth potential and a bigger piece of debt for stability. It's all about creating a smoother, more balanced ride. So what exactly is a conservative hybrid fund? Well, the name kind of gives it away. It's an investment that's mostly in safer things like debt instruments, but it dips its toes into equity just a little bit for that potential growth boost. It's perfect for someone who wants better returns than a savings account, but without all the drama of the stock market. And this isn't just some loose guideline. It's an official rule from SEBI, the market regulator in India. As you can see, these funds have to invest between 75 and 90% of their money in debt, and only 10 to 25% can go into equities. That structure basically locks in its conservative nature. It keeps it true to its goal of being stable. All right, so you've found the just right category. You're almost ready to go. But hang on, before you put a single rupee in, there is one last super important thing you have to check, and that's the price tag. Seriously, asking this one simple question can literally save you thousands, even lakhs of rupees over your investing lifetime. Because even funds in the same category can have wildly different costs. And that key factor, it's called the expense ratio. Think of it as an annual management fee. It's a percentage of your investment that the fund company takes out every single year. The lower that number, the better for you, because it means more of your money stays invested and working for you. It might seem like a tiny number, but believe me, over decades, a small difference in that fee can compound into a massive amount of money. So let's just pull this all together into a super simple checklist. Your first fund checklist. Step 1. Choose your strategy. Go for that moderate risk option to build good habits. Step 2. Find the right fund type. You're looking for a conservative hybrid fund. In step 3, check the cost. Always prioritize funds with a low expense ratio. And that's our explainer. It's really that simple. We'll leave you with this final thought to chew on as you start your journey. By starting with this balanced approach, what kind of investor will you become in the future?